presentation of TFNN. The Tom O'Brien Show is produced every business day. Tom takes your phone calls toll free at 1-877-927-6648. Internationally at 727-873-7618.
Let's go to John in Orlando. John, what's going on, brother?
Good afternoon, Tom. How are you?
I'm doing great, man. Yourself?
Good. I want to tell you, I've been listening to you since your radio days back in '99. Appreciate what you guys do. But what I really enjoy that you brought back Tim Ward. This guy is as smart as a whip.
I am so happy for that feedback.
Yeah, because he's one of a kind. He's got to be the #1 market timer. I'm telling you, it's like he calls it really, really good.
He does. I really appreciate the feedback, man.
Yes.
Now, Tom O'Brien.
Filling in for Tom O'Brien. I'll actually be with you until next Monday. Should be a good thing. First things first, I want to talk about. We are now on a bunch of different social media platforms. Give us a follow out there. If you're on YouTube, make sure to like and subscribe. That really helps us out. We are on Instagram as TFNN Corp. And we're on TikTok as well for all you young guys out there. And that is going to be Tiger Financial on TikTok. Having a great time with all those things. We've gotten a bunch of new people coming in through those avenues. And so welcome if you're new. So anyways, let's take a look at what we got going on right now. Of course, we've kind of had a little bit of a consolidation period and then really to the downside of the past few days. So right now we're in the E-mini trading off about 0.38% at 52.63. That is off from a high of 53.68. Now, something that I will note that is a little bit positive with all these, and we can look in, for instance, let's check out the Dow, right? You have some decreasing volume. In the Dow, it's not as stark as it will be in the E-mini. In the NQs, you see something as well, right? So you have this kind of consolidation period, and then we've been pulling back maybe the past, like 6 sessions or something like that. But this is all in decreasing volume, which is positive. We take a look at the NQs right now at 18,661. The Dow futures at 38,248. Of course, we hit that 40,000 mark and just kind of gave it up from there, and that was going up on shorter volume as well. We have the gold contract at 2,340, silver at 31.37. Copper continues to be down, right? This is kind of sad. We were trading at just under $5.20. Right now we're at $4.65. Crude oil, honestly maintaining that kind of lower bound. Now we are up at 78 when the past few times I've been on. We've been down near the 75, high 75, low 76 area. But still today we are off about 1.5% in it. Tesla up about 1.73. Then Steel Dynamics, that's been doing a massive consolidation thing on pretty low volume. Again, that kind of suggests that it wants to move to the downside, but it has done this before many times and has gone right back up to it and formed a new trading range. Now, we're talking about how we had this consolidation period in the past few sessions. You had some downward movement in it. This is corresponding as well with the dollar trading back up in a higher range, up above that 105 level. However, we are down to about 104.72 right now. So it seems like we're going to stay in this, again, this kind of consolidation area with the dollar. If it gets back up above that 105 trading range, that can send the market down. Obviously, NVIDIA blew up. I'm just trying to think of things that have happened since the last time I've been on. The NVIDIA thing was wild. You're supposed to, the shares are supposed to be less when you go through a split, and they're higher than they were prior. 1,129. It's something like a, 2.7 trillion market cap. So that's the third, it makes us now the third largest company behind Apple and then Microsoft in first place. Amazing. So, how does it look? How do we look at this, right? Okay, well, first we have Tim Ward on today. This is going to be really awesome. Get his analysis of what we're looking long term. I know a lot of people are very bullish, and I think that makes sense. I think there's still a lot of money in the market. We haven't seen such a large liquidity suck as maybe anticipated through higher interest rates. And in fact, you're seeing some weird things as well, where, one, obviously equities are going up, and so people can profit off that, but also the investments of people with more liquid cash, essentially, more assets, they're getting more money from these high interest rates. So the question kind of becomes, first, okay, let's take a look at this. Is what I really want to move into is the beige book, right? So what I'm trying to say is you have potential for this really bullish movement continuing to go on, but the economic situation is not as good as it could be. I think that we're moving away from this idea that we're going to have lower interest rates, and we're now just kind of going well, we have this money, let's continue to invest it. We're making more money off of current investments, and that can be, really in assets like land and real estate. And so you're getting this kind of, as I keep talking this, two different economies going on, right? Where people who aren't making as much money are getting really hammered by some of this stuff, but people who have enough are doing okay, and I think this is moving the market up, and we're losing talk about any kind of interest rate cuts that were fueling these all-time highs, but we're not really pulling back in any major way from it, which is why I can kind of say that this is almost like a consolidation, especially on the lower interest. The beige book came out. This is basically kind of a summary of the 12 financial districts of the Federal Reserve. I want to take a look here, and this can kind of give you a synopsis too, because again, what we've been talking about is, when do we see these rate cuts come down, right? They're trying to hit a 2% target, but what's important to know is that it's over time. It doesn't mean we hit some low number, like low CPI for the month, and then, okay, all of a sudden we're lowering interest rates. That would be a very grave misstep, because then you can go and really fire back inflation up, since capital is cheaper when you lower the interest rates. So let's take a look at the overall economic activity. The national economic activity continued to expand. Okay, we're looking for not really a retraction, but kind of a stabilization, but this is just a slight expansion from early April to mid-May. However, conditions varied across industries and districts. Most districts reported slight or modest growth, while two noted no change in activity. Retail spending was flat to up slightly, reflecting lower discretionary spending and heightened price sensitivity among consumers. That is notable in lower income earners, right? They're pulling back the discretionary spending. There is an article, I can pull it up, but the factor was if you make over $100,000 a year, you feel rosier about the situations right now. If you're making below that, it's a little bit of a struggle. So auto sales are roughly flat, with a few districts noting that manufacturers were offering incentives to spur sales. Okay, traveling and again, this is kind of what you want to see, this decrease in economic activity, and over a longer period of time, this is when we can start, discussing actual time frames for lower interest rates. Still, as I'm saying, the market at least looks like it's doing okay even without those lower interest rates. Let's keep going. Travel and tourism strengthened across much of the country, boosted by increased leisure and business travel, but hospitality contacts were mixed in their outlooks for the summer season. Demand for non-financial services rose, and activity in transportation services was mixed as port and rail activity increased, whereas reports of trucking and freight demand varied. Nonprofits and community organizations cited continued solid demand for their services, and manufacturing activity was widely characterized as flat to up, though two districts cited declines. So we do have some stabilization, we have some decline, but overall we're still seeing a modest expansion. For interest rates, that's not telling me that this happens immediately. Folks, stay tuned. We'll be right back.
If you spend any time online researching trading techniques on how to begin your trading journey, you've no doubt come across many folks who push Forex trading as a way to make big money quickly. Unfortunately, there are equally as many stories of these so-called Forex professionals just looking to make a quick buck off aspiring traders without actually teaching the ins and outs of the Forex market. This is what sets Teddy Keckstad's The Tiger Forex Report off the riffraff. Every Monday, former Chicago Mercantile Exchange member and author Teddy Keckstad releases his Tiger Forex Report newsletter, where he dives into the complex world of Forex and takes time to actually teach you his methods that have made him so successful in the fast-paced and rewarding world of Forex trading. Furthermore, all subscribers receive access to archived live streams of Teddy's, where he provides university-level education to help you in Forex trading. All first-time subscribers receive a 30-day money-back guarantee. So what are you waiting for? Forex awaits.
The stock market is a delicate interconnecting web of commodities, equities, and trader psychology. When one string of the web is pulled, It has a ripple effect across the broader market. This is where opportunity lies. But how are you to gather all of this information into one cohesive model when you're already spending your energy looking for any possible trade opportunities? Luckily, you don't have to worry about that, as Tom O'Brien has brought all important market news to you in one single newsletter, Market Insights. Market Insights provides a daily overview of what's happening in the indexes, bonds, gold, and more. Follow along with Tom daily as he analyzes the components that affect the overall movement of the stock market, giving insight into how each one plays either a bullish or bearish role. Tom also analyzes specific equities that he believes has the potential to make huge returns, and his track record proves his analysis right. All first-time subscribers receive a 30-day money-back guarantee. So what are you waiting for? Don't let the market leave you in the dust.
Are you ready to take charge of your financial future? TFNN is your gateway to the world of trading and investing. Whether you're starting out or scaling up, TFNN empowers traders and investors of all skill levels with top-notch investing systems, strategies, and techniques. It's time to protect and grow your money with insight you can trust. Join us live Monday through Friday during market hours for exclusive content that moves with the markets. At TFNN, we bring the trading floor to you. Our seasoned hosts are here to answer your calls and questions live on the air. Check out the Tiger's Den for just $1 and follow us on YouTube and become part of our vibrant community. And remember, at TFNN, we're so confident in the value we provide that we offer a 30-day money-back guarantee on all new premium newsletter subscriptions and services. You have absolutely nothing to risk, so why wait? Tune in live to Tiger TV and transform your trading journey, because when you know better, you invest better. Join us and experience the difference today. TFNN, educating investors.
Call now, toll free at 1-877-927-6648. Internationally at 727-873-7618.
Welcome back, folks. Before we went to the break, we were talking about the Beige Book. It's kind of just the overview of how these 12 financial districts are doing. And we're seeing slight growth. We're seeing some stagnation in certain areas, which is kind of what we want to see, and then a little bit of decline in certain districts as well. Anyways, one of the things I was talking about before going through this is that, again, you're having two separate pressures, right? So you're having people on the lower end of the income spectrum. They're struggling a bit and they're feeling these high interest rates, but people who are making a little bit more are actually doing fine. And it tends to be that people now, obviously not like you and me, but larger companies with all this money are the ones who can tend to drive inflation a lot of times as well. Let's take a look here. This is from JP Morgan. And what they argue is that we're actually in a selective recession that only affects the poorest Americans. So the divide between lower and upper class Americans is pretty great right now. You have the consumer at the high end who's being more choiceful. They're not on the lower end. There's less spending. This guy this is the analyst, Matthew Boss. He added that 70% of low-income consumers are feeling the pinch despite remarkable wage growth and cooling inflation. Something that's kind of interesting as a little tidbit with this is I was at one of my usual haunts when I'm off of work. A guy was in the back of the cafe that I go to, and he had one of those Oculus Rifts on, and he was actually doing work. So I was like, dude, can I try that out? And I put it on. It was insane. I mean, he had all his computer monitors up, so many windows, and you could still see people behind. But another guy there, we were just kind of, speaking a little bit about that technology, and somehow got in, what I do and what TFNN is here. And, I was talking about what the point of these high interest rates are, Phillips curve, all this kind of stuff, and just talking about general employment. And one of the guys said he works over VoIP, right, which is voice over IP. And he works for a company and he just manages the VoIP connection to make sure that it's working. Now, with his job, he's supposed to just be working for this company. But since he works at home and it's, I guess, supposedly not a very difficult job if you've been doing it for long enough, he works for 3 separate companies entirely. And these are 2 other jobs that are taken up by one individual that are supposed to go to many. And, I don't know how that factors out in the full way, but I know that there's got to be something there that's probably happening on a large scale, especially within tech. And then definitely since the advent of work from home. Anyways, I think that's kind of interesting. I'm going to dig a little bit more into that, ask some more people who I know in tech if they know anything more about that as well. So the COVID era savings are gone. Obviously, we've spoken about a lot of credit card debt and so on. 67% of middle-class households say they're feeling the impacts of inflation. Primerica's survey results show that 27% of respondents plan to contribute less money to the retirement savings this year to help make the ends meet. And meanwhile, another 60% don't believe they're currently saving enough to retire comfortably. There's a lot of weird pressures right now. And that's the truth. And so if you're trading based on the idea that we're going to blow up because we're going to have low interest rates, I would temper that idea and push it out a little bit, the horizon for that. I still think we're probably going to be making or approaching all-time highs just because there's a bunch of money, just a bunch of liquidity that's still in the economy in general. 1 second, I'm getting a DM. Ha, fantastic. Would you look at that? Guys, I want you to come over here and look what we got going on. Onto Google, and then I'm going to type right into that URL browser, ord-oracle.com. This is Tim Ord. He comes on every Tuesday and Thursday, the Tom O'Brien Show, and we love his analysis. Tim, how are you doing?
Good. Thanks for having me on again.
Absolutely. We're happy to have you. What are we looking at today? I know we got the weekly SPX on chart 1.
Right. It's just this is a quick view. It kind of looks at the bigger picture. What happens at the bottom window is the weekly SPX VIX ratio. Next window up is the weekly SPX. And I want to show here as the VIX actually gives you a warning. Pretty much the VIX leads the S&Ps a lot of times. And the SPX VIX ratio, if the SPX makes a higher high, then the ratio makes a lower high, which is all the kind of shaded pink areas, are times when the market's probably going into a short, or at least a short-term high, if not an intermediate-term high. Excuse me, intermediate-term high. But right now, to the far right, the S&Ps has made higher highs, and along with the SPX VIX ratio, it's made a higher high. So there could be short-term pullbacks, but the intermediate-term trend is still up. So let's kind of look at the next window and see where we are right now.
Perfect.
Which is chart 2.
Fantastic.
And, well, first thing, the top window is the daily SPX. And I got blue there. We gapped above the previous high of late March, early April. And we gapped above it, and we left the gap open. Last Thursday, we tested that gap on 5% lighter volume. You need at least 10% lighter volume to really conclude that would have been the low, and the market starts going back up. Since it was about 5% lighter, there's a good chance that last Thursday's low, which is circled in red there on the chart, we go back down and usually test that low again, and we're doing it as we're talking right now.
Yeah.
And so what's important here, what needs to happen, is volume needs to be 10% lighter than last Thursday's volume. And this chart I drew about a couple hours ago, it's obviously lighter there, but as we're going closer to the close, close is approximately about a half hour away, and volume's going to be at least 10% lighter, if not even greater.
Yeah.
So probably, in my opinion, we're probably making a low right here, right now. And to help substantiate that setup, if you go down to the second window up from the bottom, that's the VIX. And like I said before, VIX usually leads the way in regarding the SPYs. And if you notice, the SPY right now is down about 0.62. And if you notice, the VIX is pretty much down a little bit, but on the chart it's down. But as we're talking right now, it's still down from yesterday. So if you get the VIX down and the SP down, so the VIX trades the opposite of the SPY. If the SPY is down, the VIX is supposed to be up. But
nice.
Since the SPY is down and the VIX are also down, that's actually a bullish divergence. So it kind of helps support that we're making our low because we got 10% lighter volume testing last Thursday's low, and the VIX is not rising here. I'll put it that way. it's at best as even. So that's a divergence. So a lot of times these lows don't form on Thursdays. A lot of times they form on Fridays. So we may have a little bit more back and forth tomorrow. But right now, I think we're in the vicinity of making a low. We've virtually gone sideways for the last, looks like about, 2 weeks, 3 weeks now. So this is probably, again, the halfway point of the next move up.
Right.
So it's not of a significant top of any consequence, but is today going to be the low? There's a good chance, but like again, if you're Thursday's not the best time, but a lot of times Fridays are making the low, so we may see a bit more low tomorrow, but not much. I'll put it that way.
Absolutely.
I hear the music.
Yeah, Tim, stay right there. Folks, we'll be right back with Tim Ord of the Ord Oracle.
Many trading newsletters attempt to focus on a narrow set of equities or commodities. While this works for some, it oftentimes misses many opportunities that possess huge gain potential. But how is an independent trader supposed to scan the entire market looking for these hidden opportunities? One simple answer: the opening call newsletter. Basil Chapman, developer of the Chapman Wave trading methodology, has been trading the markets for longer than most trading influencers have been alive. And over that time, he has honed his methodology in order to accurately call movements in a wide range of equities, from semiconductors to uranium to key indices and so much more. Basil is old school, taking the time to educate the trader while also giving his insights into key indices, selective stocks, and more. Opening call subscribers also receive access to dozens of educational live streams that can be accessed at any time for your edification. All first-time subscribers receive a 30-day money-back guarantee. So ignore the pop trading influencers and start learning time-tested technical analysis.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
Tigers, you've seen a show, you've learned from his webinars, and now it's time to trade side by side with him. Join Larry Pesavento for the second month of his new service, Live Trading Fridays. Hosted in the Tiger's Den trading room on Discord, Larry has analyzed a number of commodities and indices, placed profitable trades, and explained his method. Whether you're new to trading or are a seasoned market veteran, trading side by side with a titan like Larry Pesavento will only enhance your game. Utilizing Fibonacci retracements and ABCD structures, Larry provides decades of insight into when to place trades, when to exit, when to ignore, and so much more. Learning is doing. So if you're serious about learning technical analysis and becoming profitable in this uncertain market, Live Trading Fridays is a must-have tool in your arsenal. Live Trading Fridays occur every second and fourth Friday of the month, so trading events for this month are May 10th and 24th. If you're serious about trading, we'll see you there. TFNN, educating investors.
This portion of the Tom O'Brien Show is brought to you by Direxion's daily leveraged and inverse ETFs. Whether you're a bull or a bear, you choose the direction. Visit Direxion.com. Investing in the funds involves significant risk and should only be utilized by investors who understand the impact of leverage and actively monitor their portfolio. They are not designed to track the underlying index or security for more than a day. Before investing, carefully consider a fund's investment objective, risk, charges, and expenses contained in the prospectus available at Direxion.com. Read carefully. Distributor Foresight Fund Services, LLC.
Okay, Welcome back, everyone. This is Jacob Shoup filling in for Tom O'Brien. We are currently joined by Tim Ord of the Ord Oracle. Tim, we were just looking at chart 2 before the break. We were talking about the VIX and the SPY both being down, which is a bullish divergence. And then the music rang.
Right.
So.
Yep. And also, when you break, right now, this is the last thing on the SPYs here, but we're breaking the previous low of the last Thursday. And to break a previous low, you should have a sign of strength, which is basically a big price move and an increase in volume. And both those things are not happening. Right. So this is, again, probably the low right here, but I'm not sure what tomorrow is going to bring. But anyhow, price-wise, we're setting at the low. Let's flip to chart 3.
Absolutely. Okay.
This is a monthly chart. Month ends tomorrow. May 31st is tomorrow. And so this is going to kick in most likely. I mean, days, I guess, things can happen, but there's probably a 95, or I don't know, probably higher than that, 99% chance that these 3 charts or these 3 indicators are going to kick in on Friday's close. And the bottom window is the monthly GDX-GLD ratio. The next higher one is the higher window rather is the monthly cumulative advanced decline, and the top window is the cumulative monthly up-down volume. So to get these signals, you get 1 is pretty bullish. You get 2, that's really bullish. You get all 3, there's a high probability that this is going to work out. And to get the signal, you need these 3 indicators to close above the mid-Bollinger Band. So it doesn't try to pick out the bottom. What it tries to do is catch the trend. So that's why I kind of designed this. Yep. And the red lines on the chart, the horizontal lines on the chart, are times when all 3 indicators fell below their mid-Bollinger Band. The blue lines are the times when all 3 went above their mid-Bollinger Bands. And so right now, the last time this indicator gave a signal was back, looks like about January 2021. And I showed this on this chart before in the past. And it gave a sell signal, and it actually did have a failure back in 2023. Both of them got just barely above their mid-Bollinger Bands and fell back down. So what's the chances of that happening again are pretty slim. Normally you get a fail signal one time, the second time around is probably for real. But we got a lot of different indicators saying the same thing and different types of indicators. But right now, if you look far to the right, has a blown-up window there, and you can see all 3 are actually above their mid-Bollinger Bands. Yep. So, but today's not Friday. All 3 of them got to hold above mid-Bollinger Bands tomorrow. And if you do, you're probably looking at at least a multi-month rally, if not a multi-year rally. Previous signals at this time, the shortest distance was 1.5 years. The longest distance was 4 years. So this is really going to open the door. And the middle chart there, the monthly GDX, which is the second window down, we did break the neckline of a Head & Shoulders bottom, and I got circled there kind of in green on the volume area. You need kind of a increase in volume, and if you can see, there was an increase in volume. So, my opinion, we did jump that what I call neckline with the sign of strength. So that's actually more confirmation. So that neckline becomes support now. So this, what I'm seeing on a lot of different gold stocks, looking at the monthly charts, I don't care if you're looking at small stocks or big stocks, all of them are kind of crossing their mid-Bollinger Bands. So this is going to be a hot issue, I guess, for quite some time. So let's flip to chart 4.
Yeah, so we're on chart 4 now.
All right, chart 4. These are the same indicators, but this is on a daily time frame, so it kind of looks at the shorter-term picture. And again, it's the same type setup. You have to jump above the mid-Bollinger Band. We did back in the 1st of March, and we're just basically running above the mid-Bollinger Band. So this chart, since it's on a daily, the dailies can flip back and forth quite a bit. The weeklies are less, and the monthlies pretty rare. But right now, they pretty much stayed above the mid-Bollinger Band, and as I circled in red where we are right now, and all three of them, even on a short-term basis, were still above the mid-Bollinger Band. And also I labeled on the GDX chart, I got 1, 2, 3, 4 labeled on the chart. That's an Elliott wave type thing. And so I'm thinking what we're in right now is a 5-wave up, and we're in the midst of 5th wave right now. So this is a 5th wave up. Once it ends, you'll probably have some sort of a consolidation, but I don't see no ending on a short-term basis here. This type of indicator remains bullish, and we can look at some other indicators too. Let's go to page 5, chart 5.
Second. Let me get it up here. Okay.
Yeah, this is the bottom window is the up-down volume on a 50-day average. It's not cumulative, but it's 50-day average. And in general, when this indicator, this works best for the GDX, up, down, whatever. But anyhow, when it's up above zero, GDX is an uptrend, and all that green shaded area are times when the GDX is, or this indicator stayed above zero. And we're well above zero right now. We're coming in about plus 17, and it's holding above zero. So right now, the previous chart 4 is on a buy signal. This is short term. Chart 5 is on a buy signal because it's holding above zero. And so I don't know how high we're going to go, but it's not the time to sell yet. So let's even look at a shorter term chart. Let's go to chart 6.
Okay.
And this is previous chart was 50-day average. This is an 18-day average, so it's a little over a 3-week deal. Same thing. It acts a little bit faster, and it whips around a little bit stronger, but it gave a buy signal back in first part of March, which is basically the green area is when it's above, for this indicators, or actually there's 2 of them here, that stay on a buy signal. Both indicators have to stay above minus 10. So the bottom window is the 18-day average up-down volume. Next higher window is the GDX advanced decline on 18-day average. And they're not even weakening here. They're just holding strong, around the plus 10, plus 15 area. And this is updated today. So even on a short-term basis, the decline is still expected to continue on a short-term basis.
Awesome. Tim, stay right there. Folks, we'll be right back with Tim Ord of the Ord Oracle after this break.
If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them, using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee, so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors. For traders who crave risk, Direxion's daily leveraged and inverse ETFs provide opportunities to magnify short-term perspectives with up to 3 times a daily leverage, utilize bull and bear funds from both sides of the trade, and trade through rapidly changing markets. These are highly leveraged ETFs with daily resetting designed for short-term trading, not long-term investing. Whether you're a bull or a bear, you choose the Direxion. For up-to-date pricing and performance, go to Direxion.com. Investing in the funds involves significant risk and should only be utilized by investors who understand the impact of leverage and actively monitor their portfolio. They are not designed to track the underlying index or security for more than a day. Before investing, carefully consider a fund's investment objective, risk, charges, and expenses contained in the prospectus available at Direxion.com. Read carefully. Distributor Foreside Fund Services, LLC.
The reality is that navigating financial markets can be risky. Markets can be chaotic and difficult to understand. Having the latest market advice can help you turn this chaos into a key for creating winning trades. At TFNN, we understand that it can be hard to find reliable market news. That's why each of our market experts offers their very own market newsletter, a must-have tool for every trader out there striving to find an edge in today's markets. TFNN newsletters cover every aspect of the markets so you can analyze the market before you trade. Try any of our great newsletters risk-free with our 30-day money-back guarantee. Just visit the Newsletters tab on the front page of TFNN.com. TFNN, educating investors.
TFNN has launched the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Tom O'Brien.
Welcome, folks. This is Jacob Shoup filling in for Tom O'Brien. We're with Tim Ord of the Ord Oracle. Tim, before the break, we were looking at GDX, so I think it was an 18-day up-down volume. This is chart 6.
Yeah, there's not a lot to say about it. It's bullish. And it's not even doing a negative divergence right now, so don't know how long the rally will last. You know, we've gone on for all of March, all of April, all of May so far, and maybe July. I don't know, but if you have a 5 count up, usually that's what goes on in an impulse wave. You have a 3 count going up, that's a corrective wave. This is Elliott wave type things, and since we're having a 5 count up, we're in the 5th wave right now. So whatever comes next will be just an ABC down probably, then another 5 count up from that. But even the Elliott waves are giving bullish signs here. So anyhow, it looks good, and it's not looking. It looks good for at least the next year and a half, because that's about the minimum. If you go back to the monthly charts, that's the minimum. Once those charts kick in, the minimum is like a year and a half, and the longest one is 4 years. So the gold issues are probably going to have really a big run. So let's take a look at chart 7.
Absolutely. We have it up right now.
Chart 7, this chart goes back to 2008. And all it is the bullish percent index for the gold miners index. So it measures all the buy and sell signals using the point and figure method, all the stocks in the gold miners index. And one thing I want to point out on this is usually I have a green area there, and then I have a red area on top of that. But the green area is ideal for a continuation of a bull run if it stays between basically 60 to 95. That's, in other words, the stocks in the gold miners index are that are on point and figure buy signals are like 60% of them to 95% of them. If you get above 95%, which is that red area up there, usually that's too much, and usually you get tops. So that's what happened in 2016. 100% of the stocks in gold miners index were on buy signals, and it turned out to be a top for a multi-year period. Same thing happened back in mid-2020. About 100% of the stocks were on buy signals, and the market consolidated for the next 4 years. Mm-hmm. So you really don't want to have 100% of the stocks on buy signals, because that's too much. It's just too much.
Yeah, I get it.
So, as a matter of fact, even in 2011, I think it was about 95% of them got on buy signals. So we're sitting at around 90% right now. So ideally, you don't want to go much higher than this, especially if you get to 95. So something to point out, too much of a good thing a lot of times can be spell trouble. So, I'm hoping that, consolidations are actually good for the market. And so I don't want this gold market just to keep on running, even though it may run for another couple, 3, 4, 5 weeks. I hope it doesn't run for the next 3, 4, 5 months. If it did something like that, it would probably be an ending type situation, which is not good for everybody.
Yeah,
So
you get
I'm
like
thinking we're
overbought
gonna
essentially, right?
Probably peak out in July and start some sort of consolidation then.
Fantastic.
So,
Fantastic. That's great for gold, and definitely. And folks, if you want these charts, I'm going to put them in the Tiger's Den at the end of it. You can also send me an email as well at jacob@tfnn.com. Tim, is there anything else you wanted to look at chart-wise?
No, that was kind of it. So it's the S&Ps are probably making a low in this vicinity right now, and the gold market, chances are we're probably going to. The gold market probably has bottomed in March, and we're actually probably bottom in October of 2023. That was the major low. The next impulse wave has started probably March 1st, and this next impulse wave could last months, if not years. So it should be a really good time. A lot of these gold stocks are penny stocks, and most of them are probably going to turn into $5, $10, $15, $20. Some of them. So I think this is probably similar to what happened back in 2000. Which I was part of too. So a lot of similarities between now and then. So we'll see how it lays out. But right now, both the gold market and the equity market looks pretty good.
Fantastic. Tim, thank you so much for joining us. Everyone, you can go visit him at the ord-oracle.com. Tim, we'll see you next Tuesday. Can't wait to hear. And again, we were talking about the SPY with low volume, even looking at the E-mini right now. But if I pull up the SPY, that's what we were looking at the beginning of this program, right? We're kind of pulling back a little bit, but the volume just keeps drying up as it's testing these lower levels, which is a good sign for a SPY in general. So,
yeah, SPY, because we're not going to reach. I think the last high is last Thursday was close to 60 million. We're not even going to come close to that, but it only has to be 6 million, be 54 million or less. And if it happens, then the odds are high that this is probably the low right here. But I'm still thinking if it's not today, it's probably tomorrow. So either today or tomorrow is going to be the low.
Absolutely. So, Tim, thank you so much for joining us. We'll see you next Tuesday.
All right. Thank you. Bye.
Take care now. Folks, again, if you're just tuning in, we're going to have that interview we just had with Tim Morgan. That's every Tuesday and Thursday, but it's phenomenal insight every time. We're going to have it up on YouTube shortly after the end of the trading session for the day. Strongly recommend checking that out. And, if you like Tim Ord's metals analysis, which how could you not? I mean, again, like months ago, he was one of the guys calling this, almost historic run-up we've had in gold. Right now, the gold contract trading roughly about $2,338. We're still looking at a $2,500 target overall in gold. That's not Tim. That's, what we're looking at over at TFNN. But seriously, quite an immense move. Obviously, this is on the monthly, and it's pulled back a little bit. But if you look at it year to date, I mean, come on, right? This has been a lifeless kind of commodity for so long, and then we've really, really pulled up on it. If you want to get some cool exposure into some gold as well, like you're listening to this and you're like, well, I've never traded gold and I don't want to buy physical gold or anything like that, and you want something interesting, I would recommend what our friends over at Direction have. Now, this is Nugget. This is a 2 times bullish ETF. Very fascinating. I would go check them out at direction.com. And then, so this is a bullish one. And then we have Dust, the ticker, and that is going to be the bearish one as well. But we can see this coming down, 1.16 right now. And then Nugget up the same as well, since they are totally inverse. All right, let's move on here. Of course, actually, again, it's been a little bit since I've been with you guys. Ethereum ETFs are passing. This is huge. I believe that BlackRock just got a $10 million seed fund for it, or excuse me, posted one, which is massive. I have always said that I think that this is going to be, this currency in particular is really going to be the one to focus on. Or I'm trying to pull up something that we had on stable coins as well, if I can for the time. Okay, well, first, let's talk about the Ethereum a little bit. Ethereum ETF, so yes, BlackRock did get $10 million seed investment, $10 million seed investment, and Grayscale adds Coinbase custody. So BlackRock and Grayscale have updated their U.S. spot Ethereum exchange-traded fund filings to add a seed investor and establish a custodian. I'll talk a little bit more about this. We have a short segment up next, but guys, this is this is what you've been looking for. If you're in crypto, this is massive. Not only have they now accepted ETFs for Bitcoin, but now Ethereum, which in my opinion and a lot of traders' opinions, this is the currency of the future, at least what things will be based on. Folks, stay tuned. We'll be right back.
The stock market is a delicate, interconnecting web of commodities, equities, and trader psychology. When one string of the web is pulled, it has a ripple effect across the broader market. This is where opportunity lies. But how are you to gather all of this information into one cohesive model when you're already spending your energy looking for any possible trade opportunities? Luckily, you don't have to worry about that, as Tom O'Brien has brought all important market news to you in one single newsletter, Market Insights. Market Insights provides a daily overview of what's happening in the indexes, bonds, gold, and more. Follow along with Tom daily as he analyzes the components that affect the overall movement of the stock market, giving insight into how each one plays either a bullish or bearish role. Tom also analyzes specific equities that he believes has the potential to make huge returns, and his track record proves his analysis right. All first-time subscribers receive a 30-day money-back guarantee. So what are you waiting for? Don't let the market leave you in the dust.
In the world of trading, only a few names stand out like Larry Pesavento, a pro's pro with over 50 years of experience. Larry has seen it all. A former Chicago Mercantile Exchange member, Larry has authored 10 books and trained over 1,000 traders with his unmatched expertise. Introducing Fibonacci 24/7, Larry Pesavento's daily trading service that turns the complexity of markets into opportunities. Published every Sunday, receive a comprehensive report packed with detailed commentary, charts, and videos that illuminate the patterns shaping the markets, with updates throughout the week exclusively for subscribers. Whether through charts or videos, Larry's analysis is your roadmap to navigating the markets. You can sign up now at TFNN.com for just $97. And with all TFNN newsletters backed by a 30-day money-back guarantee, you have nothing to risk. For all the details, visit TFNN.com. You'll find Fibonacci 24/7 right under the newsletters tab.
The reality is that navigating financial markets can be risky. Markets can be chaotic and difficult to understand. Having the latest market advice can help you turn this chaos into a key for creating winning trades. At TFNN, we understand that it can be hard to find reliable market news. That's why each of our market experts offers their very own market newsletter. A must-have tool for every trader out there striving to find an edge in today's markets. TFNN newsletters cover every aspect of the markets so you can analyze the market before you trade. Try any of our great newsletters risk-free with our 30-day money-back guarantee. Just visit the Newsletters tab on the front page of TFNN.com. TFNN. Educating investors.
Don't forget, you can listen to TFNN live on your mobile device 24 hours per day. Go to TFNN.com, then hit Watch Tiger TV. That's TFNN.com, then hit Watch Tiger TV.
Welcome back, folks. Jacob Shoup filling in for Tom O'Brien. We were just talking about Ethereum actually getting the go-ahead to have ETFs open on the traditional market. It's being done through BlackRock and Grayscale as well, which I think is a really cool step forward for the crypto world as well. But now the question comes, you know, when you get these things passing, then Congress really starts paying attention to some stuff. And now there's a lot of questions in Congress going on around stablecoins, namely Tether, right? So they're supposed to be pegged essentially 1-to-1, right? So 1 USD to 1 Tether and so on. And this is other cryptos can essentially be built upon this or kind of insured by it as well. One of the things I wanted to talk about that's kind of interesting. So Tether's, right, this is Tether. They have a market capitalization of 111 billion. That's USDT. It surged in value. Tether's latest report showed that while most of its assets were in cash and in short-term government debt, almost 16% was in corporate bonds, precious metals, secured loans, Bitcoin, and an opaque category of other investments, which I always love reading on financial statements. So by contrast, its nearest rival, $33 billion USDC, which is not, I mean, it's there, but Tether is the number one. It reports that its assets are all in cash at reserve banks or in its own SEC-registered government money market fund composed of cash, short-term treasuries, and overnight repos. Okay. That sounds reasonable, of course, is what they're saying, but even the cash reserves can be risky if they're not in safe hands. This has happened with them before. Now, this is kind of interesting. You had a discussion between the links of stablecoins and treasuries, right? So one of the House speakers recently speculated that sensible legislation could boost the token's market value in trillions. That would, increase the demand for treasuries. But in that scenario, a run on major stablecoin could lead to a massive selling of treasuries, rating distress across the wider financial markets. My point in saying all this is no doubt going to need to be brought in to the traditional market, and you can't ignore it anymore. I mean, you now have the ETFs via some of the largest private equity groups in the world. Tether has a market capitalization of $111 billion. It's being used more and more and more, and it can't be avoided anymore, and we have to take it seriously. Folks, thank you so much for joining me. I will be back tomorrow with you guys during the same time period and Monday as well. I hope you all have a great rest of your day.